Money. It defines and shapes our lives. We spend the formative years of our lives training how to get it, the productive decades of our lives working for it, and the closing years of our lives worrying whether we saved enough of it. It is the backdrop of our economic existence, and we all use it each and every day. But still, how much do we even know about it? As independent reporter Jeff Swanson discovered at last year's Occupy Vancouver protests, even those who claim to be protesting the current system don't know the basic facts about money's existence or where it comes from.
Why are you here today?
Well, just to pretty much just check out the support, to bring the kids down so that they can see and be used to a lot of people, and I don't know, support what we kind of know and see what else is going on pretty much, yeah.
Well, let me ask you what you know. If you were planning a family, you'd want to know where babies come from, right? You've got a couple of them.
Yeah.
So this has a lot to do with banking and money. Where does money come from?
Well, I have a pretty different outlook on money. It actually comes from like trees, right? It's made.
So I can cut down a tree and make money?
Well, no, there's a bit of a process, but that's the whole problem, is that anybody can kind of make it.
Legally?
That's the thing. Anybody can make money, and that's one of the big problems. It's a misconception. Money's not important.
What is money?
That's it. It's not important. It can be made on trees. It's not important.
So I want to ask you, where does money come from? How is new money created?
It's created on a promise system.
On what?
A promise system, usually people's credit cards.
Well, I mean, I've got a $20 bill in my wallet. Where did it come from? Under what conditions can new money be created?
I'm pretty sure they can print off whatever they want.
What is money? Well, I got some right here. A picture's worth 1,000 words. This is money. That's money.
Sadly, these types of befuddled responses about the underlying nature of our economy is by no means limited to any particular group, party, or political affiliation. Instead, it is a widespread, pervasive ignorance that has been bred into us by a system that does not teach us even the basic facts of economic history and often uses confusing, jargon-laden terms to obfuscate basic ideas. Ironically, the simplest question of all is perhaps the most difficult for many to understand. What is money? Our confusion over the nature of money comes from an historical contingency. In our economy, the dollars or pesos or yen circulating through the marketplace in fact serves three separate roles at the same time. Firstly, and most obviously, it is a means of exchange. In the US context, legal tender laws mandate that Federal Reserve notes be accepted for all debts, public charges, taxes, and duties. This makes it a reliable, universally accepted instrument for exchange. Secondly, the dollar simultaneously serves as a unit of measure. Given its recognizability, products are priced in dollar units. Thirdly, the dollar serves as a store of value. Dollar earnings can be stored and used later to purchase products at some later date. Just because these three functions seem identical to us in our current economy, however, does not mean that all three roles have to be fulfilled by the same instruments, or even that they should be. Most people are aware that the dollar's utility as a store of value is highly questionable. Even if they don't understand why the value of the dollar is constantly falling, they know enough to invest in stocks, bonds, and commodities instead of keeping their long-term savings in dollars. But what about having the unit of measure also act as a means of exchange? Is this advisable? A builder is never prevented from constructing a house because of a shortage of inches, but people are often prevented from buying because of a shortage of dollars. If there is interest in a product, and the underlying productive economy is sound enough to support such transactions, why do money crunches occur? And why do they prevent people from transacting? But this leads to another important question. In this age of panic over the sovereign debt crisis and the fiscal cliff and the debt ceiling negotiations, we're bombarded with talk of government money printing and images of the printing press. But how many people know that only a tiny fraction of money in the economy is actually in the form of bills or coins? And if money isn't, for the most part, literally printed into existence, then where does it come from?
In the present, money is literally created as debt. New money is created whenever anyone takes a loan from the bank. As a result, the total amount of money that can be created has only one real limit: the total level of debt. Governments place an additional statutory limit on the creation of new money by enforcing rules known as fractional reserve requirements. Essentially arbitrary, fractional reserve requirements vary from country to country and from time to time. In the past, it was common to require banks to have at least $1 worth of real gold in the vault to back $10 worth of debt money created. Today, reserve requirement ratios no longer apply to the ratio of new money to gold on deposit, but merely to the ratio of new debt money to existing debt money on deposit in the bank. Today, a bank's reserves consist of two things: the amount of government-issued cash or equivalent that the bank has deposited with the central bank, plus the amount of already existing debt money the bank has on deposit. To illustrate this in a simple way, let's imagine that a new bank has just started up and has no depositors yet. However, the bank's investors have made a reserve deposit of $1,111.12 of existing cash money at the central bank. The required reserve ratio is 9-to-1. Step 1. The door is open and the new bank welcomes its first loan customer. He needs $10,000 to buy a car. At the 9-to-1 reserve ratio, the new bank's reserve at the central bank, also known as high-powered money, allows it to legally conjure into existence 9 times that amount, or $10,000, on the basis of the borrower's pledge of debt. This $10,000 is not taken from anywhere. It's brand new money simply typed into the borrower's account as bank credit. The borrower then writes a check on that bank credit to buy the used car. Step 2. The seller then deposits this newly created $10,000 at her bank. Unlike the high-powered government money deposited at the central bank, this newly created credit money cannot be multiplied by the reserve ratio. Instead, it's divided by the reserve ratio. At a ratio of 9-to-1, a new loan of $9,000 can be created on the basis of the $10,000 deposit. Step 3. If that $9,000 is then deposited by a third party at the same bank that created it or at a different one, it becomes the legal basis for a third issue of bank credit, this time for the amount of $8,100. Like one of those Russian dolls where each layer contains a slightly smaller doll inside, each new deposit contains the potential for a slightly smaller loan in an infinitely decreasing series. Now, if the loan money created is not deposited at the bank, the process stops. That's the unpredictable part of the money creation mechanism. But more likely, at every step, the new money will be deposited at a bank, and the reserve ratio process can repeat itself over and over until almost $100,000 of brand new money has been created within the banking system. All of this new money has been created entirely from debt, and the whole process has been legally authorized by the initial reserve deposit of just $1,111.12, which is still sitting untouched at the central bank. What's more, under this ingenious system, the books of each bank in the chain must show that the bank has 10% more on deposit than it has out on loan. This gives banks a very real incentive to seek deposits in order to be able to make loans, supporting the general but misleading impression that loans come out of deposits.
Last year I had a chance to discuss the nature of our current debt-based economic system with Paul Grignon. the filmmaker behind the Money as Debt documentary series.
We are currently enslaved or encircled by a concept of money as a single uniform commodity in limited supply. And we took on that concept of money because it did not have any technology other than to make small valuable objects that we could carry from place to place. To this money. So for long distance trade, we had to develop silver and gold coins. And they were valuable because those things were rare and hard to come by. So that technological limitation doesn't exist anymore, and yet we still conceive of money as a quantity in limited supply that we have to get from somebody. And we're trained to think that we're trained by the news. We watch the printing press cranking out dollars, and that reinforces the false idea that the government prints money. Only it did, it would be a little better.
Yeah, well, that's exactly right. I think, again, we are tricked on so many levels, and you're right, a lot of people have this conception that money is this physical cash that we see getting printed out.
Well, if you go by what you see on the news, that's the image they feed you, right? You always get the picture of the mint, it's either coins or your bills coming out, because we are taught to think that all of the money, including the numbers in our bank account, are the same as those dollar bills. The numbers in our bank account are promises of dollar bills. When we go to the bank and ask for them in cash, our bank balance in cash or some part of it in cash, then the bank's obligated to give it to us in cash. But otherwise, that number is just a promise of cash on demand. And since we do almost all of our business these days using the promises of cash rather than the cash, the banks don't have anywhere near enough cash to cover all their promises. And why should they? Cash is already almost obsolete, just as paper cash replaced gold as the basis of the money system. Now there's really no practical need for paper cash either. Really,
so if the money isn't the cash,
there's a serial number.
Well, yeah, that's about right. Well, if the money isn't the cash then, and if it isn't what we think of in terms of the press or the mint, then what is the role of the central banks? I know it varies from country to country, and the Bank of Canada is different than the Federal Reserve, but overall, what is the role of a central bank in a system like that?
Well, the central bank is the entity that gets the money printed. Okay, so the money in Canada, there's two different printing companies that do the printing, and then actually in the United States, it is actually a government agency that does the physical printing of the cash, but it's not the government agency, it's the Federal Reserve that gets the cash printed for the cost of the paper and the ink. And with that cash, they then buy government bonds, which are taxpayer debt at interest. And so so people think that cash is somehow better than bank credit, but in actual fact, considering the government debt just keeps going up and up and up, cash is a debt of the taxpayer on which you're paying interest forever. In a way, it's worse than bank credit.
Once these frauds are identified and revealed, the moral bankruptcy and underlying lunacy of our system is laid bare for all to see. In a system where money is created by bankers out of our own promise to pay them back at interest, it is self-evidently always the case that more and more of the hard assets and real value of the economy will be transferred from the working productive classes to the financial speculators at the top of the system who literally create the money and toy with the credit that is our economy's lifeline. Given all of this, is it at all surprising that we have arrived at this situation where economic crises are followed by multi-trillion-dollar bailouts of financial institutions, where more and more people fall into debt, foreclosure, and unemployment? The question, of course, is how to transition from this system to a more rational one, an economy that actually rewards productive work and allows the growth of the money supply in line with people's actual needs. This is a question that we will turn our attention to in next week's edition of this series. For the time being, it is enough to note that at times it is the simplest questions that turn out to be the most difficult for many to answer, and if we are being told not to ask such questions as what money is or where it comes from, perhaps there is a reason that the powers that be don't want these questions being contemplated. This video is brought to you by the subscribers of BoilingFrogsPost.com. For more information on this and other topics, please go to BoilingFrogsPost.com. For more information and commentary from James Corbett, please go to CorbettReport.com.